We now turn to Module 4.1, and this is a major shift to another part of the book. We will be focused on valuation for several chapters. Once we finish with valuation, we'll go to static risk measures, then dynamic risk measures, and the book will conclude with addressing some portfolio issues. In Chapter 4, we address US Treasuries, corporate bonds, and common stocks. And this particular module, we're going to be focused on valuing US Treasuries. We can't do good management or risk measurement without good valuation models. And so what we'll do in this particular module is focus on the technical details of US Treasuries, also known as USTs. We're going to understand the weaknesses of traditional valuation approach, and we're going to apply the LSC model to constant maturity treasuries for the purpose of relative UST valuation. And so before we get to the technical details of US Treasuries, it's good just to briefly look at some statistics. The global bond market is massive, and this is a relatively old excerpt of based on McKinsey's Global Institute, and there's about 169 trillion as of 2017. The United States is the dominant participant in the debt market, followed by China, Japan, France, and so on. The global bond market in 2016, according to the Bank of International Settlements, again, we see the large players, United States, European Union, China, Japan. If we compare the stock market, it's not surprising that the U.S. has the largest stock market in the world, based on the 2017 data, as well as more recent data. And so when we consider the U.S. Treasury market, it's 15% of the global bond market. The U.S. Treasury market is 37% of the U.S. bond market. And as of Q1 2019, it's about 16 trillion in size. As of this recording, obviously that number has dramatically increased in light of the pandemic and fiscal deficit spending. UST denotes both notes and bonds. They're semi-annual pay, which means there are 2 coupons per year. Bonds are quoted without accrued interest, and they're typically quoted as a % of par. And so your invoice amount will differ from the quoted price that you see on some computer screen. The central financial concepts of traditional U.S. Treasury valuation, the way I see it, is kind of like a hamster running in a circle. It's simply a tautology. You start out with the yield to maturity. That yield to maturity yields a quoted bond price once you adjust for accrued interest. Well, where did that yield to maturity come from? Well, the input was the quoted bond price adjusted for accrued interest. And so you just run in a circle. You really haven't done any kind of independent valuation. What we're going to do is we're going to look at something known as constant maturity treasuries to sort of a first attempt at getting an independent source of relative valuation. And so before we dive into the technical details, just to be sure we're on the same page, the U.S. Treasuries have a variety of different quotation conventions. Generally, they're quoted in 1630 seconds. And so 101-16 means 101% of par in 1630 seconds, or 101.5% of par. If there's a half, that means if there's a 5 in the third digit, that's basically 1630 seconds and 5/8 of a 30-second. And then you can proceed in the same way. And so you need to be familiar with how bonds are quoted. Make sure that you do the right conversions when you do different valuation exercises. This was taken out of the Wall Street Journal. Basically, often you have the maturity date, the coupon, the bid, the ask, the change from the previous day, and the ask yield. And so we would expect this ask yield to correspond to that ask price. And if you'll notice, that as for higher coupons, for example, the 6.65%, when the yields change, the higher the coupon, the larger the change. And so it turns out there's going to be something known as the coupon effect, and we'll look into that in more detail when we get further along. Treasuries are paid semi-annual, typically on either the 15th of the month or the last business day, and they're quoted on a modified business following method, meaning that if that day happens to fall on a Saturday or a Sunday, the coupon payment will actually be made the following business day. It's paid on the business day. If it is a business day, then it's paid. If not, the following business day without any corresponding interest. U.S. Treasuries are quoted on a 3360 day count basis. Thus, it's 1/2 of the stated coupon. And all the coupons on a particular bond will be the same. The yield to maturity is simply a function of the U.S. Treasury market price. And we looked at this in Chapter 3 when we were looking at embedded options. The mathematical results are based on a particular bond valuation expression. We could write down the valuation in different ways. We could assume discretely compounded interest, or we could assume continuously compounded interest in our valuation equation. At the end of the day, the yield to maturity to bond value is simply a tautology without a whole lot of insight. Constant maturity treasuries is freely available. It's available at the H15 file. It's based on the run Treasury, U.S. Treasury securities, and it provides a yield estimate even when no bond is trading at that maturity. And this is taken from the H15 file from the Board of Governors of the Federal Reserve Bank. And what we see is the constant maturity treasuries. We have 1 month, 3 months, 6 months, and then 1 2, 3, 5, 7, 10, 20, and 30 year. And so what we're going to try to do later on in this chapter is we're going to take the nominal constant maturity treasuries and then value each individual treasury bond based on fitting this curve. Constant maturity treasuries assumes a par bond, and that is basically the coupon is equal to the yield to maturity. Some of the properties, they go from 3 months to 30 years. They're interpolated by the Department of Treasury from a daily yield curve. Unfortunately, their particular methodology is not made public. It's based on the closing market bid yields of the actively traded U.S. Treasuries. It's freely available at in the H15 file produced by the Board of Governors of the Federal Reserve System. So if we apply the LSC model to CMTs, the CMT yields form the basis for estimating what I call a base curve or base spot rate curve. The fitted model is used to estimate any maturity CMT as CMT proxy. With that par bond curve, we can derive discount rates which form the basis of valuing any U.S. Treasury. This provides a relatively independent valuation approach. So if I'm comparing a 4.25-year bond with a 4.75-year bond, yield to maturity has all kinds of problems, but by fitting this curve, generating discount factors, and with those discount factors valuing the bonds, we can figure out which one is over and which one is undervalued. And we're now going to go over some of the technical details of U.S. Treasuries, computing yield to maturity, and then applying the LSC model. Some of the parameters of a U.S. Treasury note, there's an annual dollar coupon, the number of coupons per year. In this case, this will always be 2. Mortgages, that would be 12. And so it's not always 2. If a quarterly pay bond would be 4 times per year. The par bond is the notional amount or the principal. F is the fraction of the payment period elapsed since the last coupon. This fraction is used in estimating and calculating actually the accrued interest. Remember, bonds are quoted, U.S. Treasury bonds are quoted without accrued interest. And so the CF sub I is the ith cash flow. and which is basically the coupon divided by M, which would be the coupon each period. The very last cash flow is going to have the return of par. Otherwise, it's just coupon divided by number of periods, which in this case would be 2. Now, not economically, but legally, accrued interest is calculated by the fraction of the period that has elapsed already, the dollar coupon paid per semi-annual period in a percent times the par value. The fraction of the period already elapsed is the number of accrued days since the last coupon payment, and divided by the number of total days between the two coupon payments. So mathematically, the quoted price is simply the value of the bond minus the accrued interest, where the bond valuation equation is as we saw before, with a little more technical details. We're allowing for a fraction of the year. We're allowing for different payment frequencies during the year, and we're adjusting for the accrued interest. For discrete compounding, there's the bond equivalent yield is calculated exactly like we were looking at before. If we just let CF sub I be the cash flow, we can make this a little simpler. Notice if I use continuous compounding, I have e to the minus yc times the fraction of the year that has elapsed. Notice that this tau sub I is counter I minus f, which is the fraction of the year that has elapsed already. And so if we start out with the value of the bond, we solve for the yield to maturity. And then if we use this yield to maturity, we get the value of the bond. In both cases, we should get the same value of the bond, but we will get different yields to maturity. And this is an important consideration when you're trading bonds, is that the yield to maturity is a function of the mathematical model used to calculate the yield itself. So if we look at a particular example, suppose the settlement date is June 4th, 2021. The maturity date is May 15th, 2041. The coupon rate is 2.25%. The bond is quoted as 113.30 seconds. The reported yield to maturity is 2.224632. Thus, because this is a 20-year bond, there's 40 remaining coupon payments. In this particular case, I recommend that you go and check this to make sure you understand the mechanics. The number of accrued days is 20 days between the last coupon payment and the current settlement date. The number of total days is 184 days. Thus, the fraction of a period that has elapsed already is 0.1086 and so on. Thus, the accrued interest is 0.1222826. And so the accrued interest on $1 million par is $1,222.83. This is the end of part 1. When part 2, we'll pick up on various US Treasury calculations.